Hi, everyone. Good. I guess we're 12 o'clock on the dot here, so I'm going to say good afternoon. Hi, my name's Ross. I'm from Function Point. I'm here with my co-presenters, Jimmy Wu from Function Point and the infamous or famous Vince Dong is with us as well. We're just going to wait 2 minutes for any stragglers to come in. There usually is a wave in the minutes as we open up webinars. We really appreciate you coming here today. Thanks for your time. We have some really awesome content to show you. So we'll just give it a couple of minutes for any last people to come in. The numbers are coming in now.
I've never eaten so fast in my entire life.
Vince, you cued me to my first question. So we sent out the Uber Eats gift cards. We hope everyone got them. Would anyone like to raise their hand and interact and tell us what they had for lunch? Vince, tell us what you had for lunch.
I'm currently hoovering a grilled cheese sandwich and the most amazing chicken noodle soup.
Beautiful. Okay, so we're at 9:02. It looks like most of our attendees are in. So so we will. Oh, somebody did answer me. Fabian, thank you. We have some interaction. Look at that. 2 double pizzas, pepperoni and chicken mushroom. Still eating. That is the name of the goal, or the name of the game here. We thought it would be nice to do a bit of a lunch and learn style thing. Seeing corporate lunch and learns are over, and I can't travel to where you are to take you and your team for a lunch and learn. So we thought this was second best. Fabian, enjoy your pizza. Pepperoni chicken mushroom sounds pretty good. So again, welcome to the webinar. We'll get started here. The first thing I'd like to do is introduce our guest host, Vince Dong. Vince and I go back. Vince, how many years? 8 years now, I think, about that.
About closing in on 10 anyway.
Man, it's a long time. Vince, do you want to tell us who you are and what you do and why you're so renowned in the industry, Vince?
Thank you for your kind words, Ross. And there are some of us that have been in this industry for a number of years. I consider myself old now in the industry, and I have what I will say a unique set of skills that's taken 34 years to acquire. So every ad agency that I walk into, I do so with my CPA hat on because I earned that degree years ago from that small accounting firm called Ernst & Young. I worked at an ad agency, and after a number of years, I decided to open up an accounting practice focused in the advertising industry, a management consulting firm focused in the advertising industry, and a software business focused also in the advertising industry, where I am, to the best of my capabilities, being agnostic, because the programs that I work with are all focused in the advertising industry. And love the business, love helping out agencies, particularly love helping out agencies if they are remotely interested in making more money. Back to you, Ross.
Good introduction, Vince. I'm Ross. I'm Function Point's Manager of Strategic Business Development. I handle some day-to-day sales, some strategic partnerships, like Vince is one of our strategic partners, and just make sure that the company is going in the right direction. And one of the directions we're taking the company now is to build up an agency community, a community of agencies that want to do better. hence why we're all here today to talk about these important metrics. Jimmy, do you want to introduce yourself?
Sure. Hey, Ross. So hi, everyone. My name is Jimmy Wu. I'm the Director of Sales and Marketing here at Function Point. I've been with Function Point for about 7 years now, but I actually had an agency background. I used to be in my previous life a project manager for a marketing lead generation firm. So, and then decided I kind of sucked at that, so decided to join a software company instead, and worked out a lot better. But I still really enjoy the industry, so I really like working and helping agencies being able to be more efficient in their operations.
Okay. Now, Jimmy, do you want to share your screen, and we'll get started with the content for today?
While Jimmy's getting started, I want to hear how that pizza's tasting.
Some of you may not have been in when I asked, but we were curious to ask if anyone has used the gift card to order any lunch, and what you had for lunch. Mitch Tobel didn't get his Uber Eats gift card. Mitch, we'll get you out your gift card. I'm hungry too. I can relate. We'll get you that out. Just as Jimmy's sharing his screen here, one thing is those gift cards expire today at the end of the day. So if you haven't ordered lunch, make sure you use them for dinner.
I'm sorry, when do they expire?
They expire at the end of the day today.
Okay.
It's our first time trying this lunch and learn thing, so we apologize for any little hiccups. Jim, do you have the deck ready to go here? Well, while Jimmy's bringing up the deck and we're dealing with our technical challenges, as we often do, I'm just going to introduce the topics for today. So today we're going to be talking about, when we advertised it to you, we said top 2 metrics. Vince would not let us do 2, so instead we're going to do 3. Vince required 3 financial metrics. These are your core metrics that every agency should be tracking. So those 3 metrics are agency profitability, so looking at P&Ls by client, by job, by AE, so understanding what clients are more profitable, what AEs are more profitable, what type of work is more profitable. We're going to be looking at employee utilization, so how productive your staff are, what your realization rates on those staff are. So as far as seeing who is making you money and who is costing you money, which flows directly to the last topic today, which is write-offs. So we're going to be looking at, of those staff that are making or losing you money, and of those clients that are making or losing you money, how much are you actually realizing and how much are you writing off? How much are you losing in dollars and cents? So those are going to be our 3 topics. Jimmy is unable to share his screen, and GoToWebinar wants me to reset. So let me try one more time here.
Oh,
there we go.
I think I
okay, I have 3 metrics. Does everyone see 3 metrics on their screen?
I do.
Excellent. So Vince, over to you. We'll start with agency and client profitability.
Jimmy, we're going to, thank you very much. For those of you that have been in this business for some time, and those of you that are just getting your feet wet into this business, it never ceases to amaze me how people in the industry have a unique interpretation to the word profit. We all know what loss is, certainly, but the word profit is something that needs to be clearly delineated today for everyone's benefit, to take back to the owners. If there are owners on this call today, for owners to truly understand what the word profit means and where do we find this information? How do we derive this information? Is this standard in the industry? And going backwards, absolutely standard in the industry. If everyone is used to getting a company income statement, they certainly will take a look at it, gloss over it to see what their bottom line looks like, and it may or may not be a profit number that they have any relevance to, or maybe look at last year's numbers. And for those of you that are taking notes today, we in the industry use a 50, 30, 20 percentage feature that's an industry standard series of percentages. We use 50% of labor against our AGI line. We use 30% of overhead against our AGI line. And then we use 20% profit against our AGI line. Now the word profit, which will be consistently discussed today, is after all expenses. And if you want to take it one step further, it's operating profit. So excluded from there might be the sale of a vehicle or some furniture or hard assets, nothing to do with the agency itself. Excluded in there might be any trading losses or gains that you might have in terms of investments in your portfolio of money, should you decide to keep some of that money inside the agency's corporation bank account. And the word profit is something that you should certainly monitor against an AGI number. And so to define AGI in the industry, it is gross billing. Some people call that revenue, some people call that gross revenue. Subtract cost of sales. If there's anyone in this call that has the allocation of salaries of their agency upstairs in cost of sales, Ross can steer that company in question to me, and I can have a further conversation with them offline to say that there is no need, no reason to have salaried bodies in cost of sales. If you've got permalancers in there, which we sometimes call freelancers, that are people working in your company that are not on payroll, by some miracle, they always book 30 hours to 40 hours a week, they have also no business sitting in cost of sales. They should be part and parcel of your labor category, which when further unraveled, it's salaries, benefits, and those contract labor people. So if you are north of 20%, let's say 25 to 30%, great. If you are south of 20%, you've got some room to move on. In 2020, our industry's most challenging year ever, I had some clients earning between 30 and 40% bottom line profit, which was spectacular. Their secret to success had to be industry-based experts in certain silos, instead of just being a generic type individual ad agency with a plethora of offerings to many different industries. So what does this have to do with the client profit and loss report? It is not enough for an agency to just see how much money they've made or lost at the agency level. As importantly, and equally more importantly, and I'm moving away from the financial reporting discussion, and I'm moving into something called a management reporting discussion. Those accountants that are on the line right now with a formal university degree, or quite potentially a CPA, CGA, CMA, or CA, would have studied management accounting to essentially see how the agency or any number of companies tick. So when we start talking about a client P&L, we're actually talking about a management report that eventually ties back to the company's income statement. And when I mean eventually, your internal reporting, regardless of how many clients you've got, would take every one of those client profit and loss numbers, and in totality, be able to tie that back to the company's income statement, so that you get to see just how profitable or unprofitable your clients have been. I'll give you an example of a client that I have actually continued to work with. They have been averaging 5% profit a year, which in my private opinion is with a ton of room to grow. When we polled their individual client profit and losses, lo and behold, half of their clients were losing money like crazy, and half of their clients were marginally profitable. When you added that all up, you had the conversation of, well, we're only making 5%. And for the lesser experienced accountants, they would immediately go to the owner of the company and say, well, we have to fire these 50% clients so that we can continue to improve on our bottom line. And as time goes on with more sage-based accountants, they would certainly approach each and every one of those money-losing clients to say, let's peel back some people on this one. Let's go and add more cheaper people on this one. Let's go to the client and say, look, you continue to get this Bentley each and every year, and yet you only want to pay Volkswagen Golf prices. Can we talk? And we are actually in the business of making money as opposed to being a not-for-profit or charitable organization. So those kinds of discussions would certainly be spurred by analyzing a client profit and loss report. So how do you get to a client P&L in the agency world? And we're going to go 1, 2, 3, 4, and I've explained AGI already. Some of you have already likely figured out Vince is doing this backwards. And the reason why I'm saying I'm doing this backwards is if you can understand it backwards, doing it forwards is a piece of cake. So number 2, direct costs of time. These are your people that show up every day that presumably enter something called a timesheet. And if you don't have a timesheet, you are not producing client P&Ls no matter how hard you try, wish, and hope. Because the direct cost of time is based on how many hours you put into your timesheet, daily, weekly, or monthly, multiplied by your hourly cost. And once again, if you want to find out what the hourly cost is, you contact Ross and then he can contact me because there's a unique derivation in the determination of the hourly cost rates. And for those of you that have studied cost accounting, once again, some of you are going, oh, this is interesting. This is creating a value at standard cost for every employee that comes into the agency and works on client work or particular jobs or new business or agency professional development or clients that are needing time against them, but we can't bill any of that because it's on a particular retainer. In any event, it is key for complete time reporting each and every month so that you can get accurate client profit and loss reports. So with that being said, some of you are going, how does that work against the company's actual salaries and actual benefits and actual contract labor amounts sitting over in the company income statement? And this client profit and loss report does calculate labor at cost, but does not do an allocation of salaries. And that's also incorrect because if Ross was being paid $100,000 a year and he put 10% of his time on a particular client, one would say, well, we'll just allocate $10,000 of Ross's time in there. However, Ross is a hard working slave for his agency, and he finishes the month in question with actually $18,000 of cost time. Well, as a result of that, the $18,000 should be posted in that particular client to reflect the blood, sweat, and tears of Ross at standard cost, and not the $10,000 that we paid him. So that brings us to number 3. The overhead calculation starts with the actual outlays in your company: salaries, benefits, contract labor, rent, Ross's Lambo and Porsche that he drives, all of those costs. And we then subtract from there the totality of the direct costs that have been allocated to clients so that we have a net overhead amount for distribution to each and every client. And in doing so, we are reflecting the overhead allocation on a per client basis based on the percentage of actual cost time on every client. With Ross, as an example, his client has consumed 30% of the total standard labor costs in the month in question. So therefore, the net overhead allocation should be 30% against the client, thereby reflecting a formal fixed charge to the client's profit and loss report, which leaves number 4. Number 4 is 1, subtract 2, subtract 3, and you'll get your bottom line profit or loss for each and every client. How often should we be doing this? No less than once a month. On the basis that we've billed on a timely basis, on the basis that people have actually put their time in for the month in question, and on the basis that Ross's accountant is in fact booking all those overhead expenses for the month in question so far. So that's a key metric that your agency ought to review each and every month. I'll move on to the next slide, Jimmy. So I'm going to start on the employee utilization with these 2 sentences. We'll use Ross as the whipping child for this example as well. Some employees are 150% billable, yet only 25% realizable. Other employees are 50% billable, yet 100% realizable. What does that mean to your agency? Our utilization discussion, which is topic or metric number 2 right now, and while we're moving in 2021 in the direction of value-added billing or fee billing with no necessary connotation to efforts involved, there still is a large movement away from the old days of earning 15% commission from media. And that means more and more agencies are still stuck with this issue of external billing rate multiplied by the number of hours, determine how much to bill to the client. And this second metric that we're looking at here is to find out where there's leakage, where we aren't realizing what we're supposed to be realizing, where we can improve on staff. Perhaps the clients are in fact a reason why we're not making the money we should be making. So this part of the conversation now breaks into 2. We absolutely have to take a look at productivity. Billability is another way of saying this, and we'll use Ross once again. I expect Ross to punch in no less than 2,080 hours in a year, which would include the entire population of his time entry, including vacation, administration, being a pain in the ass, non-job related things, plus working on clients. In the meantime, I expect Ross to post no less than 1,500 hours, and there's a reason why I mentioned that number, on client work. The remaining 580 can go into agency productivity work, new business work, admin work, professional development, the like. And if I say to Ross, I expect you to work 2,080 hours on clients, Ross would probably look at me and go, did you just visit the cannabis store next door? How on earth do you think I can get 2,080 client hours in a given year? Do you know how hard I work? Well, sure, okay. Let's adjust your client work to an industry standard of either 1,400, 1,500, or 1,600 hours in a year, which is not only more reasonable, but it gives Ross the other 500 and change hours to not work on specific clients for the benefit of the agency. The 4As uses 1,400 hours. Second Wind uses 1,600 hours. I use 1,500 hours. I'll just sidebar very quickly to Second Wind. I'm one of the lead consultants for Second Wind. It's based in Pennsylvania. For those of you that have not have heard of Second Wind, it's an amazing resource that packs all kinds of content. It's got dialogue going back and forth with any agency that wants to get information from other agencies, supercharged webinars and seminars. It boils down to, even if you needed to get a job description for a project manager, those kinds of descriptions are around. Annual cost is less than $700 a year, and it's you'll pay itself back with one reach out to the people at Second Wind. So that being said, we're back to the whole utilization discussion. So we're going to focus on productivity for starters, then move to utilization in a second. We're back to Ross, and we'll give you 3 examples. In the year that Ross was supposed to have worked 1,500 hours, he's actually only put in 1,200 hours. And for all of you that are not close to a calculator, that works out to 80%. Now, we've actually set out 1,500 hours as the company's goal for every employee, but we haven't adjusted it downwards for the person's stature in the organization. In this case, Ross happens to be an account coordinator, otherwise known as Grunt. And when his account directors grunt, they ask him to do something, and he moves. Now, strangely enough, though, he's not at 1,500 hours, he's only at 1,200 hours. And why is that he's only at 1,200 hours? And what do we do with the other 300? It's up to the director of operations, Ross's immediate superior, perhaps even the owner of the company, to review Ross's productivity against his 1,500 hour goal, and if need be, take him to the back woodshed and have a further conversation with him over a beer, or outside standing in a winery going, well, Ross, what's been going on here? And it could be for any number of reasons. But this kind of reporting should be reviewed each and every month. Example 2, Ross is yet another eager account coordinator. And at the end of the year, he's actually put in 2,000 productive client hours. He's actually beyond all of the other hours that he's worked. So his total hours that he's put in are 2,600. It might be suggested that Ross needs to get a life, or he's just getting started in the agency world and he really is excited about learning as much as he can, but he has now exceeded the 1,500 hour requirement by 33%. Commendable, or maybe we're just giving too much work to Ross. And once again, it is important to look at Ross's productivity relative to the goal that we set. If we don't set a goal, then we don't have a frame of reference for Ross to be compared against. So many agencies should be establishing goals for employees to look at moving forward. I'll move to employee utilization at this point in time. And in the 2 examples that I gave you, Ross put in 1,200 hours. From a productivity standpoint, he was only 80% productive. In the meantime, those 80% hours, we billed out all 1,200 hours. Ross was a superstar in the first example. And mathematically speaking, the utilization in that case was 100%. So while we're looking at productivity, it is just as important to see, have we turned those hours into money? And in the example that I gave you, we turned 100% of Ross's 80% productivity into money. Let's go to example B. Ross put in 2,000 client hours when we only needed him to put in 1,500. In the meantime, we billed a grand total of 1,000 of Ross's 2,000 hours. That made him 50% utilizable. It may be because he was learning first year on the job, we credit him for the productivity. It may be because he was working on difficult jobs, difficult clients. It may be because his boss put him on the absolute worst clients where he had to learn a lot, which is not necessarily a bad thing, because if he could learn this stuff at the beginning of his sojourn in the advertising business, anything after that would be way more productive, way more utilizable, et cetera, et cetera. On the flip side, let's say Ross is a 15-year veteran in the agency world, and we use the same numbers. 2,000 hours that he posted on clients, 1,000 hours that he actually turned into money. Wouldn't that incite some interesting conversations for Ross to have a further discussion with us? So it's equally important to tie this back from an employee utilization standpoint to look at it in totality. If you're a 20-person shop, wouldn't it be interesting to see how much revenue each employee generated and tied it back to the income statement? And then you could see who your thoroughbreds were, who your people were that could stand for improvement, and why are some of these people barely covering their own labor cost? And once again, these kinds of mathematical equations are interesting to see. Whoever, by the way, is creating these tables, these reports, should equally prepare something called a qualitative analysis. The quants are the easy part. The why this person produced the way they did is the more intricate part, which requires conversation, dialogue, and discussion, possibly recommendations as well. Maybe we should send Ross back to AE school. Maybe we should send him to AE school to begin with, because we didn't put him there when he was hired fresh out of college. And that would essentially make you pay attention more so to your staff, who are supposed to be ideally having the same utilization as the productive hours. So we'd love Ross to have produced 1,500 hours for clients, and we'd love Ross to bill 1,500 hours as well against clients. That way, Ross is certainly making money for his clients. Okay, that was metric number 2. Number 3. A couple of years ago, I was in Chicago with an ad agency and had just started some discovery work with them to help them make more money. And the owner presented me his income statement, and he said, "Look, Vince, I made $600,000 last year." And we were in the somewhere between 11 and 12% profitability. So instantly I knew in my mind he had room for improvement. And then I said, "Terry, would you show me your write-off report?" And he looked at me and he said, "I don't know what you're talking about." And the controller said, "I'll provide that for you." So he came back 10 minutes later, and the report said that year's write-offs equated to $600,000. Terry just about had a heart attack. And I said, imagine having half the write-offs and having $900,000 in profit instead of 6 write-off and 6 profit. And immediately he set in motion a more technical, timely, precise review of this thing called write-offs. And when I say write-offs are typically time and money that exceeds the estimate and decidedly not billed to the client, that's what I'm specifically talking about. We are not talking about billing a client $1,000 and the client says, "I'm not paying you." That's a bad debt expense. We're talking about time that we haven't even billed to the client yet at this stage, okay? And with all of the attendees here, it may be a moot point. Perhaps all of you never, ever, ever have write-offs. You create an estimate and you're 100% bang on each and every time. And that might be the conclusion of point number 3. I have some suspicion that maybe 1 or 2 of you have jobs where your actuals slightly exceed your estimate. Ross, I'm sure that this is rare for any function point member. So what we do is we turn this thing into a science. because to analyze write-offs in just one category doesn't tell you enough. My client, Terry, had only one category, just called it write-offs. And I said, well, what about when one of your employees goes rogue? What about when you've got a super demanding client that wants, once again, the Rolls Royce, but doesn't want to pay any more than a Ford Escort? What about those staff members that just can't get it together? They haven't had their Weetabix or Wheaties in the morning, and it just takes them forever, given the task they've been assigned for the day, and they just take 3 times the amount of time. So let's go through these different write-off reasons and ask ourselves, is this really important to track? For those of you that even start tracking this, I'd set a goal, by the way, for expected write-offs in a year, something in the neighborhood of 10, 20, 30% of your expected profit. For those of you that are going to actually exceed your profit for the year, you've got a lot of work to do in terms of seeing whether your whole estimating process is working well, whether your day in the life of a job is as efficient as it can be, whether your clients are dealing with the wrong agency by saying, you know, Ross, we really love your work. Just keep giving it to us, and we're happy to pay you 33 cents on the dollar. And I suspect you all have 1 or 2 clients in this regard. Anyway, getting back to the write-off reasons. The first one is called client misunderstanding of the use of time. Regardless of the estimate, the client has blinders on, and if it's a $50,000 estimate, they may say, well, let's see if we can push the client, the agency, and maybe they just won't issue us revision invoices or requests for revisions, and we'll just keep pushing them and pushing them and pushing them. Jimmy, who's on this job, says, sure, and he continues to put the time on there. And now Jimmy's got a $60,000 actual billable time amount against a $50,000 estimate, and somebody's got to write that $10,000 off. It is so important to categorize these write-offs. It isn't funny because we're right back to the client P&Ls that have to be reviewed every month, the utilization that needs to be reviewed every month. It's the write-offs that are just as important to review each and every month. Deliberate misuse of time. These could be creative people. You can't tell me how many hours I can be allocated for this piece of work. I will take as much time as I need to. Well, let's say that this person uses 30, 40 hours in a particular concept when we've only allocated 10 hours. And this person should really have a conversation with the owners to say, look, we're all on the same team here. And so long as you continue to do this, we're going to lose money on these particular tasks that you've been assigned. Experienced but improper use of time. We run into this time and time again. A creative director just wants to get it right for the 17th time. Why? Because it's important to them. Is there something called the word budget that they don't understand, or the word estimate that they don't understand? You'll find an inefficient use of time happening where certain people just have difficulty prioritizing the work that they're supposed to be doing. This can certainly be remedied with professional development, with coaching, improving the day-to-day review, and checking in with that staff member in the meantime. All of these things can be improved upon. And an inexperienced use of time. Oh, we'll right back to Ross again. Ross just started work with this agency, fresh out of university, eager, but doesn't really have the experience of how to handle a drug pharma client yet, because he's been working in hardware stores all this time. Well, we would chalk that up to inexperienced use of time. Many agencies today that I'm still running into don't issue purchase orders for whatever reason. And so when these vendor costs come in excess of a telephone call or a verbal, and we can't bill this to the client, we've got worse, not so much unbillable time, we've got a third-party cost that we've got to dig into our own pocket, pay the vendor, and this unexpected vendor costing would certainly be cauterized if the agency commenced using purchase orders effective immediately. Any number of agency principals I have run into somehow accept friends and family clients at the expense of the employees of the company. Not much that the company employees can do, but when we constantly have these discounts happening, I'll accept that on occasion you're going to have these things happen. But in my example of the $600,000 write-off, let's say we have this constant friend or family that tugs upon write-offs each and every month to the tune of $100,000 a year. Now, something like that ought to be brought up to the owner of the company to say, Ross, your brother, Bill, he just takes us to town all the time. Is there a reason why you keep giving these kinds of discounts to your brother, Bill? And might Bill be referring 10, 12, 15 new agency clients to you? Well, then we would hold on to Bill in the meantime. Principal investment is subject to interpretation. It also requires professional judgment. Too many agency owners go, well, let's go after this company with Pop Pop Fizz Fizz, and it's got a red label on it, and it tastes like Coca-Cola. Let's put in $250,000 of time into this thing because maybe the win might be $250,000. Once again, we should certainly plan for principal investments on an annual basis from a budgeting standpoint. But if we see this creeping up more and more and more, we really need to take stock of the use of our staff members' time, because once that day is gone, it's gone. They can't get that time back. And we've flushed so much money down the toilet for so-called principal investment, it's not funny. And in fact, there should be at least a couple of people decidedly in the direction of saying, yes, let's take this on as a principal investment. It should not be just one person, because maybe that person is just not in a position to look at a block of time to be invested in objectively. Misscoped. Anybody that's a project manager today in an agency and has had a number of years should, within a tolerance of 5 to 10%, get a job in pretty closely, unless it's called that dreaded website. And I haven't run into an agency that has the perfect estimate created for a website. On occasion, you might get a client and say, charge us what you want to charge us, but that's not even scoping. That's sort of bill a client as you go. It is important to see how we craft our estimates on a template by template basis so that we can find out where we are misscoping our estimates. And it may certainly be social media. It could be content-based work. It could be media-based work that we are simply misscoping. There are a few others that are superfluous, but these are the principal write-off reasons to absolutely track. And it's not just a matter of taking a look at the time that we had to write off. For those people that like the touch, feel, and smell of a dollar sign after the numbers, it's just as important to show Ross, we wrote off $118,000 last month. That's actually double the $55,000 we wrote off the month before. How do you feel about that? And that kind of hard-hitting information in summary format is absolutely critical to improving your bottom line. So, Ross, I've explained the 3 key metrics. We have some more at a later date, but I'm just saving that for, again, whenever the next seminar is. I can hand the baton back to you.
Thanks. Thanks for using me as your sample there too, Vince.
No charge.
Yeah, so we have a bunch of questions that have been asked, some really good ones. We're just going to do one thing before we go into questions here. Jimmy Woo is going to take us on just a quick sneak peek of our software to show you how these reports can be easily generated inside of Function Point. Just a quick background for all of you is Function Point is an all-in-one agency management system. We manage your business from start to finish, so from sales and forecasting of revenue all the way over into invoicing and expense management. with an integration into QuickBooks for all of your invoices and all of your expenses that handles all of your revenue on a GL code basis into your different AR, AP accounts, tax codes. We handle your deferred revenue with deposits. Yeah, that's a little bit about us. Vince, do you like the banner I made this morning? Clearly, I'm not in creative, but I thought I'd throw you in there. Yeah. Yeah, so Jimmy's going to take us just on a quick tour of our business intelligence module to tie the metrics that Vince has just talked about into some of the reports. We're just going to do a couple of them, and then we'll get to questions. So Jimmy, off to you.
All right, thanks, Ross. All right, well, good morning, afternoon, everyone. Hopefully your stomach is full by this point. And so what you're looking at here is just a very quick dashboard of function points. So that looks at kind of your profit, your job budgeting, your task budgeting, but at the bottom, you can also see kind of the staff efficiency and utilization. So over a period of time, if the individual, the team, the agency is actually meeting their billable hour target. So all of these inside function point is real time. So with the proper tool, you don't need an Excel spreadsheet. You just pull up this dashboard and you'll be able to see their performance right away. And even look at what's billable versus non-billable. Now, if you would like to see something a little bit more in-depth, because we all know every agency has a different type of reporting mechanism. You know, you want to look at numbers a little bit differently. So we at Function Point have decided that to create a custom reporting module that is going to eliminate the hundreds of Excel spreadsheets that you might have. So in Function Point, let's say I want to look at just a quick budget reporting. You know, and when we look at budget reporting, we may want to look at it by a company level, a job level, a service type level, and in Function Point, you can do that at any given point. So right now, in my summary, I'm looking at all my clients. Out of all my clients' job, what the estimated total is versus the actuals and what we've invoiced. And you can also see what has been unbilled, which is just the difference between your actuals versus invoiced. And I can also quickly see what the budget burn rate is for all of these clients. And if I want to drill down, I can say Great Atlantic Insurance. Let's go ahead and drill down and see exactly what type of jobs or the actual type of jobs that are going over budget. I can also visualize this in a bar graph. So one of the things I hated as a project manager is when I tried to tell the owner or finance, hey, certain jobs do take longer. It's like, no, they don't. Actually, they do. So maybe we need to charge a little bit more. So this is a great report that will be able to show you that. So you can see that branding does on average take more budget and time to complete compared to something like, say, a direct mail campaign. So let's go ahead and take a look at, that was a job and client level report, but let's take a look at a staff level report. So I'm going to look at the month of May for all my staff. And in this case, I can see all my roles. I can drill down to individuals, but for account executive, they've spent 438 hours, the billable value, and the hourly cost we talked about. Out of those billable amount, how much was actually invoiced? So you can see the operational profit loss versus what was unbilled. And I can drill this down further to see, okay, out of the 3 account reps I have, it is Ryan Creemore who actually is not making the amount of money. And let's take a look at why that's the case. And perhaps he's working on a lot, only a third of his time roughly is spent on external billable versus 52 hours are on the internal non-billable. So inside, I mean, there's a lot of different ways to dissect the report, but hopefully this gives you all a sneak peek of that.
Yeah, so we've built this awesome reporting module. All these reports are custom made. You get to see the data how you want to see it, whether it's visual or whether it's in a nice grid format here. It's all exportable. This reporting engine that you're looking at here, we know is market leading. No more canned reports. You get to make the reports that you want to make, and they get to stay that way. So now that we've just had a quick sneak peek on the business module, why don't we here? I'm going to start at the top with Patrick, who asks one question on the 10, 50, 30, 20 split that was indicated on the client P&L report. Vince, can you translate how the percentages of people versus over on the income?
I only heard part of your question, Ross. Do you want to ask it again, please?
Yeah. Can you how the percentages of people versus overhead may split on the income statement in reference to the 50, 30, 20 split client P&L?
Sure. Mathematically speaking, you're talking about, we'll use $100 for the AGI number. We'll use $50 in labor and $30 in overhead. In every agency that I've seen, logically speaking, it should be expected that labor costs exceed overheads. So there are no human beings sitting in that overhead number, no administrative salaries, no CEO salaries, no VP finance salaries. Those people also belong upstairs. So you're effectively looking at five versus three. So that's essentially a 60-40 split if you want to take a look at it in that regard. If you ever have overheads exceeding salaries, you may want to double check what has been posted in the overhead category. Are you still there,
Okay.
Ross?
Yeah, I'm still here. I just turned off the webcam. It drains my bandwidth.
Okay. Next question, please.
Okay.
All right.
There, if you'd like to ask Vince any questions afterwards.
Ross, you're just cutting
The
in
next
and
question.
so if you don't mind, I'll jump in
Okay.
and pass on the questions for Vince here. So this question is from Shandi. Would love to know if there's an industry standard for percentage of time invested to win new business versus the value of the business.
We're talking about an ROI question, and we'll use Ross as an example as well. The complication in the question also is most often there's an outside cost related to bringing in a new business, but I'll keep that aside. At the very least, I see no less than 5% in total employee time costs a year invested in new business. What I will say is if we don't get new business, we've got a stagnant agency. So it is tantamount for an agency to certainly invest into new business. I've seen upwards of 10%. And it's always an interesting metric measure, which we are saving for another day to talk about. We've put $100,000 of billable time and won a $500,000 piece of business. There's never a one-to-one correlation with any agency that I've ever seen, because usually the win factor is certainly less than 30%. But if you win a great big elephant and you think about stopping new business efforts, you shouldn't. You've got to continue to do so. So the answer lies in what are you planning to invest in new business in something called a sales plan, as opposed to just going out there and making any telephone call indiscriminately or any email indiscriminately or an email campaign indiscriminately to look at what your return on investment is. The other thing is on the ROI business, it's extremely helpful to have pre-researched what the upside of a marketing budget is of a potential client, because I'll say it even though it doesn't mean anything to say it, doesn't make a heck of a lot of sense for Ross to pitch a piece of business and spend 50 grand in billable time when the account is all of $25,000. And that requires also some judicious professional judgment as well. So I think I've answered the question.
All right, thanks, Vince. Okay, the next question is in regards to non-billable staff, whether it's admin, So for example, if an office manager or a new business salesperson, how should those salaries be factored against the billable hours for the agency? Or how would you allocate these bodies to the profit centers?
Okay, so going back to the client P&L conversation, for people that don't bill, when we calculate Ross's external billable rate, we do so under the following mathematical example. On the basis that Ross is being paid $30,000 a year, we go 30,000 times 1.2, and the 2 is for benefits, divided by that 1,500 hours. Now that's just the pure cost of Ross. In order to factor in those additional salaried bodies and other overhead costs, we're actually going to multiply Ross's hourly cost by 3 times so that we can use that number as the billable rate for estimating in the future. So that's part one. Part two, the overhead will naturally work itself into each and every client P&L from a net overhead standpoint, because if these new business people and these administrative officer people are not putting in timesheets, they will comprise part of the net overhead pool, which will then distribute themselves accordingly to each and every client P&L. So that's the answer to that question.
All right, awesome. Thanks, Vince. I know we got about 4 minutes left. I think we have enough time for about 2 more questions to go through here. I just want to let everyone know that if you do have additional questions, or if we weren't able to get to answer your questions, feel free to reach out to Vince directly. His contact and email information is right on the screen, and we will also send an email to everyone so that you can get a hold of Vince as well. So the next question we have, I think you're really gonna like this one, Vince. It's about retainers from Samantha. Would you track the utilization write-offs differently for a retainer-based project?
Depends on the software program. Let's use Ross again. He's in charge of a $5,000 a month retainer. I would absolutely track Ross's billable time against this retainer. Now, we're back to the word retainer, because it is the second most misused word in the industry after the word profit. The question is, what is the definition of the retainer relationship between you and the agent and you and the client? Is it $5,000 a month and all you can eat on Ross? Is it $5,000 a month really as a cash client invoice, and at the end of the year, Ross puts in $100,000 at billable time, and he's allowed to bill the client $40,000 more because he's advanced billed or retainer billed $5,000 a month, like a law firm? Or is it a hybrid? Nevertheless, Ross's time, his billable time, should absolutely be tracked against that so-called monthly fee to the client. And by the way, if Ross is doing his job incredibly efficiently well, and instead of putting in $5,000 a time, he only puts in $2,500 a time, the big question is, does Ross still owe the client a remaining $2,500? So while I've partially answered the question, I've asked 4 or 5 more questions in order to better understand what on earth you're trying to track. And we certainly want to put no more than $60,000 of billable time against that $60,000 a year example. But the big question is, what happens when we exceed that billable amount of $60,000 at the end of the year? So I've answered the question. This is a classic question that comes up every week with me. And it's getting to the bottom of all of this. And what do we want to do at the end of the day? Make sure that we recover all of Ross's billable time.
Okay, awesome. We got 1 minute left, so we'll go through one last question. This one's from Fabian. Hopefully you got the pizza down in the stomach now. So I keep losing money because clients increase scope mid-project. I'm building a consulting site. They now want, say, 120 pages. However, we know that they do not have the content to cover all these pages, but they insist they need it built, and which messes with the pricing and the team spirit and the continuation with the project. Should I just lose this client?
Oh, here's a really long-winded, but I'll keep it succinct and spirited. there is a communicative disconnect between you and the client. The client continues to want that Bentley, and grudgingly, you continue to offer up that Bentley. And at the very least, you should start a conversation explaining in high-level terms what happens every time they want to add 10 more pages. And I don't know whether or not you have the bandwidth to do so, but it certainly is, at the very least, the initialization of a conversation. If that doesn't go anywhere, you're going to have to look hard into the mirror and say, does it make any sense for me to keep this $50,000 a year piece of business, because maybe they may lead to something greater, bigger, etc. Or maybe we could just focus on what we do all day long and stick to our knitting. So that's certainly a consultation I'd be more than happy to have with you offline.
Okay, great. I know we're into overtime. So perhaps one last bonus question, Vince, if you have the time.
I'll give you one more last question because I have another call that just started 2 minutes ago, but fire away.
Okay, awesome. So any advice for an agency where invoicing does not match the monthly work effort? For example, invoicing in project installments 50% upfront, and then project milestones for remaining 50%.
Did you say, was the question any advice?
Correct.
We're really talking about a revenue recognition conversation in here, because if I'm the client and I get an invoice at the beginning of the month that does not equate to the efforts of the work that the agency has done, I don't care. I get this invoice, I get another invoice. What the reporting is the important issue of how do you want to have this shown on your income statement? Do you want to immediately throw this into income, even though there's a mismatch? Or ought you not treat this as an advance bill, and then at the end of the month, see how many hours, how many billable dollars have been allocated in its entirety, and say, well, if the advance bill was 10 grand, and we know that the next advance bill is going to be 20, and we've put in $15,000 of billable time on there, then we should really recognize $15,000 against that particular job as revenue for the month in question, instead of waiting until the end, unless you have a unique deliverable where you can't recognize a penny of revenue until you deliver the job. So once again, you really have to look at and saying, how ought we recognize our revenue month in, month out, regardless of how you bill the client?
Okay. Well, Vince, thanks for your time. Again, if you have any other questions, Vince's email is up on the screen there. Feel free to email him. Also thank you for attending. I hope you enjoyed your lunch. There's a couple of you that said you didn't get your gift card. We'll follow up with that after. I'm also going to send you out an email if you're not a Function Point customer, just to offer a one-on-one tour of the software to see how we can help your agency. That's it. We're overtime. Let's call it a session. We hope you've received some knowledge that'll help your business. That's what we're here to do. Take care, and may you all have a great afternoon. Thank you so much. Thank you, Vince.
Take care, guys.